Hi, and welcome to The Fault Line, a CMG consulting podcast exploring the pivotal moments where business strategy meets real-world pressure.
Today's episode, we're going to be reflecting on a few themes from past conversations we've had and bridging into some of the reality of competing today, and particularly looking at the space of private equity and firms that operate under that model of ownership. Should be a good conversation. I'll pass it over to Kim. Any introductory thoughts on the topic before we dig in?
I love that we're able to bring our audience back to previous episodes and bring it into reality for their current situation. So we all work under different operating models and different types of organizations, and to be able to make it real for folks is part of why we do this.
Yeah, absolutely. And, there are things that are, I think, truth elements, regardless of what kind of ownership your organization operates under. Uh, the health of the business, the profitability of the business, the scale and impact, the ability to retain customers, all of those apply. And there are nuances that also apply if you're trying to achieve those goals in a publicly traded, large multinational organization, or a startup, or a family-held business, or a company that's increasingly the reality, which is held by a private equity fund.
I know, Gary, you've had experience working in private equity space. For me, most of my experiences is working in publicly traded organizations or working in those startups that you mentioned, which certainly felt, I think, how it would feel to be in a private equity organization, because a lot of fast acting, right? We had to move quickly. We couldn't lose market, opportunities. And there was a lot of long nights to make things happen quick. And so I'm curious about your experience from that perspective.
Well, I'll start in the startup space, and there are some real common elements when you're hustling to try to achieve something. Somebody's got this nugget of a proposition, and you're trying to prove it out and optimize it and get through those cycles. That sense of urgency is something that is very common, because almost all private equity sort of models have a clock going. Now, some might have a clock going for 3 years, some might be 5, some might be 7, but that is a pretty common trait. I think one of the differences is many startups, whether bootstrapping or backed by venture capital, for instance, have this concept of achieve scale and then figure out the profitability. But scale becomes something that is at the forefront. And I would say, from my experience and from the experience that we have as a firm working with clients, scale is important, but in a private equity sense, many, many times they're not placing bets on the initial idea. They're taking an established go-to-market solution, or a non-core business from a larger organization, or a distressed business where there's some inherent scale already, and then they're trying to build value off of it. And so instead of this pace to get big, sometimes it's actually better in a private equity sense to get a bit smaller but healthier, and to sort of shed the weight that may have been a drag on performance. So there's
Yeah.
some
I mean, so I
similarities,
think
but nuances.
as we think about scale, right, our minds go to size and bigness, right?
Correct.
And so when we're thinking about in a startup, you might be getting big in order to sell to another organization.
Mhm.
Or to go to go public. In private equity, you want to scale, but you want to be lean in that scaling. You want to have, you're spending appropriately as well.
Yeah. And for me, again, working in the space, I've done a couple of turnarounds in that space, and had other dealings. PE for me is about, uh, in one aspect, is about understanding reality, telling the truth, even if it's uncomfortable, and paying very close attention when prioritizing things on cash flow, the health of the balance sheet, and bottom line EBITDA. So, there are times where you'll hear the phrase, we won't buy scale. We won't buy growth, because there are instances where people will say, oh yeah, we need to get bigger. We need market share. And they go and invest, but they're actually eroding their bottom line profitability, or the the pursuit of that is actually making the health metrics of the organization look a little weaker. And that's generally not copacetic in a private equity space. They want the growth, they want to achieve that, but you got to do it in a way that's actually building strength and building resiliency over time. And, you know, cash flow and EBITDA are two of those primary metrics.
You just mentioned the word resiliency, and we've done an episode recently on building resiliency. I- Talk a little bit more about how that plays into, in your experience, private equity backed firms.
Well, I think there are a couple of things here that um, play, and I'll use the example of a distressed organization, right? Maybe a publicly traded one that's not doing well, maybe has even filed Chapter 11. When private equity shows up, it's not a subtle shift. What happens is, generally speaking, there is an immediate change in leadership and expression of intention. And that is by design. And, you know, for those who aren't expecting it, it can feel a bit overwhelming at times. But the good part of it is it's a redirect of attention because, oftentimes companies don't go bankrupt overnight, right? It's very, very rare. There's a slide. There are all kinds of indicators. And what will happen at the moment that equity ownership shows up is oftentimes there's a new executive officer, there's a new chief operating officer, right? There's sort of new leadership and an articulation of this is how we intend to win. And coming back to this resiliency idea, there's also a very clear-eyed assessment of where we need to get healthier. So in one instance, right, it was a look at utilization. We've got 6 different factories out there, none of which are actually operating at the efficiency levels we would want. And so, we talk about the balance sheet. Well, we've got cash sunk into all of these things. How might we think about a shift from 6 down to 4 factories that are now running well? And, for a lot of folks, they're like, oh, yeah, that makes all kinds of sense. All kinds of companies do that. Under a PE fund,
Not
that
at the same
decision,
rate.
exactly, that decision is made quickly and then things get in motion.
Mhm.
And this idea of being proactive, being on the front foot, understanding that some bold choices need to be made in order to get the company healthy, right? Because once those underutilized assets are shed, now there's some options, right? It's like, hey, we've just freed up cash. Where might we invest? Should we retool a plant? Should we invest in entering a new market? Should we deliver innovation? Because at the same time that you're sort of improving the health of the organization, you're also building muscle that can be applied competitively. And that resiliency is good whether market conditions are really favorable or kind of like we're experiencing today in 2026, there's a lot of volatility and you may need to reset your goalposts a little bit just based on reality. But the healthier the underlying enterprise is, and the better the culture sort of embraces this idea of make choices, use our finite resources with intention, and get after it. The more success comes from the whole approach, and at the end of the day, the more value is created for that eventual transition of ownership to either a new group or management or taking a company public again.
Yeah, I mean, at the end of the day, it's an investment, right?
Yes.
So the private equity firm is making an investment buy, and for those of us who don't have enough money to buy a whole company and are, just like we would invest in a stock, we want to see it gain value, and so those measurements of value become the primary metrics for running the organization, and you want it as quickly as possible. You just made me think about the startup that I worked for that almost sold to a private equity firm. But the primary reason we didn't take that offer was because they wanted to change leadership. So we eventually sold to a publicly traded company who let some of the leaders stay on for a period of time, because that can feel very jolting, right? Like you might be looking for some cash, but you still want to be involved. And so interesting perspective.
And it's another aspect of private equity is doing the due diligence ahead of time, right? And we as a practice at CMG, we talk about the M and 3Cs. So we look at company capabilities and the competitive set and what the customer base looks like and the market conditions. Private equity takes that approach. So they come in with a hypothesis around how value will be created. They have a growth thesis. And the establishment of that helps them make a decision. And then, the first 90 to 180 days are really profound when they do take over control, because the new leaders come in, there's a new set of vocabulary, often sort of a new vibe. And, I'll go back to this idea of a turnaround situation, um, a spark of hope, because, in a couple of instances with which I'm familiar, both from client work here at CNG or direct participation, cultures will slide and there's a level of despair. And the change can actually sort of say, hey, listen, we can do this, right? Because at the end of the day, the investment is a statement of belief and intention. And I think that's something, as we sort of look at PE, private equity, like, oh, here they come, and they've got all these different behaviors. At the end of the day, they're placing bets because they believe that value can be created. And an essential aspect of the whole game plan is not just the actions, but also the people, right? Putting the right butts in the right seats, having leaders who are accountable. And that shift can feel refreshing and very motivating for an organization if they've, suffered years of challenge.
Yeah. Any advice for, we've talked a little bit about as private equity enters an organization that there may be changes in leadership. What about advice for the leaders who are still there, who didn't change, and how they begin to perform differently to meet the expectations of the private equity firm that's backing the org?
Well, an interesting one, because there is this emphasis on getting the right skill set applied to the right problems to solve. And if you find yourself in a circumstance within that sort of shift, but you're one of the incumbents, I think it's very helpful to reflect. And again, I mentioned the honesty, and we do a lot of work with folks on, hey, what is the market potential? What's the state of the industry, right? We publish those studies on behalf of clients. There's also this element as a leader of saying, okay, where are my skills most beneficial? And shifting from looking over the shoulder at what had happened and trying not to defend, but leaning into the opportunity to add value. Because you're still there for a reason. And you're there for your strengths. You're there for your
Well, and I
capabilities.
think
You're there for your experience.
that's a key one, because it is very easy in any organization, private equity backed, privately held, whatever the situation is. It's very easy to dig your heels in on a decision that you made and be like, well, I decided to do this for this reason. The market has changed. The reality of your situation has changed. And so I think what I hear you saying is be less fearful, take some chances, understand your strengths, and, show impact.
Yes, absolutely. Absolutely. And, culturally, I would say there's a truism within PE, which is a recognition our resources are finite. So we will benefit from being proactive and applying them where they're going to have the greatest impact. And that, in a circumstance where potentially there have been quarter after quarter or year after year cuts and cuts and cuts and cuts, and sort of pulling back from bold moves, or a lot of reflection on, well, it'd be nice if we did this, but the shift is not going to make it easy, right? It's not permission to do whatever you want. What it is an establishment of a culture of accountability and choice. And this is the part that, for me has been most gratifying in the turnarounds where I've, been able to work, is to be able to say to a team, we are going to do this, and then proceed to go and do it. And it's usually one where instead of 6 initiatives, we'll get it down to 1, 2, maybe at most 3, but we're going to make a significant step forward. And then with that success, we get to reset what the next success looks like. And that cyclical belief in, yes, we can, starts to suffuse the culture. And it also opens up a bunch of different possibilities. So, the The shortest putt oftentimes is not going out and finding new customers. Oftentimes, there's tremendous value in just looking at the established customer relationships and reflecting on what is it about how we serve our most loyal customers and what is it about them that makes this a solid match. And this is where I think our work at CMG, sometimes we come in as an outside voice and we can reflect that back so that an organization, much as we talked in a prior episode of the fault line, can retain a greater percentage of its customers, can increase their frequency of use, or even increase the value per transaction because there's a clear-eyed appreciation of what is valuable. And for anybody in that circumstance, that quick cadence to better results feels really good, and that's
Yeah,
something that
I want to
PE
bring together
will enable.
two things that you're talking about, and reflect on a recent client project as well, which is you're talking about focus being important and placing very few bets, but meaningful and impactful bets. And um, we worked with an organization recently who had a large strategic plan. There were too many items in it. Very quickly, we said to them, you're never going to accomplish all of these well.
Right.
We need to make sure there's fewer things so that your team can focus. Why focus is important is the other bit that you just mentioned, which is if we focus, we actually learn faster what's not working. Whereas if we have too many things, the learning is much further out of which worked and which didn't because we're spreading our resources more thinly across those things. Um, so we had a guest on recently, David Bland, that talked about decision velocity.
Yes.
And you also mentioned earlier the speed at which we make decisions being important.
Mhm.
Can you talk a little bit about the ways in which CMG helps organizations make decisions faster or focus more
Sure.
quickly?
Sure. And I think this is part of the joy of the work for me is there are two paths that we can help an organization weave together there. The first and probably the most obvious is providing good inputs for the choice. So that may be doing a competitive landscape assessment. It may be digging in, doing some additional but independent analysis of underlying data, and reflecting back what we observe. Because oftentimes people have their day jobs, they're running around, but they're not actually taking the time to then dig into all of the nuggets that might be there. So the insights there, I think, are of tremendous value. And I'm wired to want to go and find out. I'm like rampantly curious, so I'm always wanting to dig for that next nugget and the implication, and then let's go in and do something with it. The other thread, and I think this is a differentiator for us, is around the characteristics of leadership as team sport. And our Thrive number assessment being a tool to help leadership teams initially visualize and externalize how they see the world. How common is their perception of their own company's capabilities, of what's going on? Where do they have areas of opportunity to get aligned? But then even more so, and this is, I think, the joy of it, is those Thrive number results generally highlight areas of opportunity. And this is where the choice becomes really intriguing, right? With good inputs from a data or an insights perspective, and a leadership team that is increasingly cultivating a common sense of their objective and the trust among one another, magic happens. Because now we can debate, but we're debating in pursuit of the objective. And we're debating with a sufficient level of inputs to make solid choices.
Yeah,
The
I think the reason why the Thrive number assessment resonates in this space, particularly with me, is it's a mirror. It's not an assessment by an outside organization. It is a self-assessment where it's like, here's what's happening, right? We're
Yes.
looking at it. This is what we said as the leadership of an organization. It's fast. It can be done in less than 15 minutes per individual, right? So it's a really quick way to get
Hmm.
to the debate part, which
Hmm.
then can be had aligned with the objectives that your PE-backed or firm has set out for the organization, right? So you can really quickly take, here's our behaviors part, like you were just talking about. Here's the goals we're trying to accomplish over the next, whatever the exit strategy is 2 to 3 years from now, and get to work.
Yes. Yes. And the really gratifying part of it is when a group of individuals, and it might be 2 levels into the organization, the C-suite and all of their direct reports, take this assessment tool. It's pretty quick. And then we can play back and visualize something that actually turns the light bulb on. It feels validating. Oh, that's why we struggle to execute in this area. That's why, oh, we we wish we could get more traction there. So, for any leaders out there, whether you're in a PE-backed company or competing with PE-backed companies, this tool applies because it'll help highlight where you might perceive wheel spin rather than traction in your initiatives. And again, this idea of it's not just about the data, it's not just about the analytics, it's also about how we collectively get behind a choice, a priority. And so the more we can nurture that, the more fundamentally you're going to move the results of the organization forward. And if I can bridge back to your comment about startups, venture capital frequently makes an assessment when somebody pitches them. They're looking at the value proposition that's in front of them, and they're also coming to some belief about, should we place a bet on these leaders?
Yes.
And in private equity, it's actually, from my perspective, very, very similar. That's why there's usually a change with a new control, because you want the right mentality, you want the right sort of intentions, you want the right behaviors in those leadership teams to set the tone and the direction for the whole rest of the organization. And if you miss that part of it and you're only focused on the analysis, you're probably still going to under deliver on the promise of any, strategy that you put together.
What other advice might you have for leaders that find themselves newly private equity backed?
Well, I think there's a lot that it depends on what the scenario was in which you have existed up to that point. So there are equity firms out there that specialize in generational transitions in family-owned companies, right? So might be 3rd generation ownership, but the 4th generation is off doing other stuff, and equity will come in. Family-owned private businesses, and I've worked with a couple of multi-billion-dollar ones. They have a different time horizon on value creation, and so the cadence of what happens with private equity might feel quick. And there's no good or bad to that, but it is a shift in the dance steps that you have to do. Similarly, from a publicly traded company to private equity, there may be a shift. And private equity for me is, there's always a clock going, because somebody may have a 3-year growth thesis and then there's intending to monetize it. But the 3-year growth thesis might actually feel like a little relief from quarter to quarter, swinging from vine to vine like Tarzan through the jungle in publicly traded companies. Because, a lot of us have been in that circumstance where it's like, hey, we got to report to the street. We got to hit this number. What can we cut? And, we'll solve for the rest of it later. And private equity actually provides a little bit of relief from that in some ways, because their time horizon is still very focused on performance, but it doesn't have to report out in that same manner. And so, there are a couple of different things there that just, kind of recognize it and recognize that it is actually the norm. I think this is also a thing that, as we work with clients and as I, work with my network, understanding that we can help people appreciate they're not alone, right?
Yeah.
The
Yeah, I
the
think
number of publicly traded companies is down something like 50% in the US over the last 20 years, maybe 25 years. So private is actually the standard at this point.
what I've kind of heard you say over the course of the conversation so far is be ready for the speed of things to change.
Yes.
Number
Yes.
one.
Number one. Number one.
Make sure you have a team that's able to create focus inside your organization, because that'll
Yes.
be driven somewhat by the speed of change. Be comfortable making uncomfortable decisions, right? If you've worked in an organization for 20 years and all of a sudden there's PE equity in there, things are going to feel very different. So the culture of your org is going to change as well.
Yeah. Yeah. And I think also just this, some of the things that are measures, every organization is going to have its leading indicators or performance indicators. Getting to an appreciation of which of those are truly diagnostic is incredibly helpful. Understanding that you're probably living in a leveraged circumstance. So resources are going to be purposely constrained because they force decisions and prioritize. And that's one of the reasons why the balance sheet becomes so crucial, and understanding how to free cash through different actions and steps. And then the deployment of those resources behind the stuff that's really going to matter. EBITDA is an absolute bright light performance indicator or success metric, I should say, for private equity. But it is the outcome of behaviors. And it's those behaviors that create value, which is where the joy is. You know, this is what I've appreciated about being in those environments is the focus on value creation. It is a very intentional sort of starting point for how to look at opportunities, how to look at, shifts in strategy, um, and a pragmatism that says sometimes we've got to reset because we do only, in one instance, have 5 years. And if we just stay pursuing this and ignore the market conditions, we're not going to generate the value that we had intended. So we got to shift a little bit. That nimbleness is also part of being in private equity, and I think it's part of the joy of working with them as clients and partners.
Yeah. And I think for me, you're talking about the MVP of running a business, right? So when we think about minimum viable product, it's like, what is the thing we can do that delivers the highest value the fastest to market? To market in this case is the value of the organization. And there is the the focus part is where that prioritization kind of criteria comes in, right? So we do that we've done that in ways of working with smaller teams and creating the prioritization of what they should work on. And here it's at the organizational level. What is the most important thing that can be done? And, keeping track of those measurements, knowing what your leading indicators are that get you to that EBITDA are the dashboard of the day-to-day morning wake up.
Absolutely. And, increasingly, just given the reality of where we're at today, right? Market volatility, economic conditions continue to be in flux. AI is showing up as a force across all kinds of activity sets and in some key industries. There's also the reality that some of the activity in the private equity space has slowed, right? There aren't as many sales happening. So hold times with portfolio companies are extending. And that puts greater emphasis on things like organic growth. Um, and this is a sweet spot for us at CMG. Everybody in the firm gets excited when we do this. And as you look at whether it's a circumstance where the company has had its growth thesis and it was built around rolling up a sector of an industry or tucking in acquisitions to achieve the value that was aspired. Sometimes you kind of run your course and you've kind of maxed out on that. And now what? And on the other end, there could be a firm that already has a significant market share. So, add on or plug in acquisitions is not a path to growth. So now what? And that's the stuff that, we love because we can come in and say, okay, let's look at and validate and pressure test some of your assumptions about growth. Let's look at your current customer base. Let's look at where there's new white space opportunities. And then, and this is fundamental, prioritize them so that the inputs generate the outputs you want on the time frame that works for you. And I can't emphasize enough this idea of on the time frame that works for you. This is why we have offers that, you know, are assessing, but we also have accelerators where in 90 days or 120 days, working with the client teams, we can get through that whole set of activities to say, okay, and now you're already in a different cadence. You're already acting in a different way. We've gotten through some experiments, and it's that's that time aspect to me is fundamental, and that's where the joy is because We just did this with a client, over the last 7 or 8 months, where they had grown through acquisition, and then they were there. There was still an expectation that they were going to continue adding value and growing. So now what? Well, let's look at all the data. Let's look at your processes. Let's look how you work cross-functionally. And the ability to step back from that after a few months. And we just got an update yesterday that talked about like the momentum that continues to build. That's, that's why working in this kind of business is so much fun, because you can see that progression.
Great conversation today, Gary. Appreciate your perspective and experience. Look forward to having more of these conversations in the future.
Me too. Thanks very much. And for everybody out there, thanks for listening to The Fault Line. Find us wherever you get your podcast, or come to cmgconsulting.com, and we'll be back soon with another episode for all of you.